Welcome to the Capital News. I am your host, Alex Karitis. Today is Wednesday, March 25th, 2020. Thank you so much for joining me. Title of today's podcast is Stimulus to the Rescue. Of course, yesterday we talked about $6 trillion. That ought to do it, because that is what White House Economic Advisor Larry Kudlow told us, at least initially, what the price tag of all of this insanity was going to cost us. Yes, us. $6 trillion. About $4 trillion from the Fed. That being, of course, the Federal Reserve, and $2 trillion from Congress, which is, of course, us. Congress doesn't have money. They don't make money. They take it from us, the taxpayer, we the people. So stimulus to the rescue. Shortly before the start of this podcast, the Senate did vote, and they did pass this $2 trillion monstrosity. It is the largest such stimulus package passed in the history of the United States. Of course, there might have been some others. Of course, you'd have to adjust for inflation and all that stuff. But nevertheless, $2 trillion with a T, a capital T. And I don't think this is it. I think there's going to be more. You already have some Democrats, such as Speaker of the House Nancy Pelosi. I mean, she's just chomping at the bit. I mean, she's ready for round 2, round 3, round 4. As long as it takes, doesn't matter. We'll just continue to throw more money out into the system. This woman has been waiting for this her entire life. This is insanity. And we continue to have politicians arguing about stupid details of all of this stuff. I mean, the markets, they did okay today. Most of them were up in the green. The NASDAQ actually closed slightly down for the day. They were doing nicely until sort of about a half hour before the end of the day, the trading session. You had some rumors out there circulating that some senators weren't going to pass it, or they were going to defy it a little bit. Hold it out there a little bit longer. And of course, one of them was Bernie Sanders. If we're not going to do health care for all, can we do this? He was one of them. Because there were Republicans on the other side saying, well, look here. Talking about all this money. And when it comes to unemployment insurance and all of this other money that we're giving out to people, you're also tacking on perhaps an additional $600 per week for people who are going to be collecting unemployment insurance, which would put most people well above what they were making when they were employed, which would imply, these senators argue, that it would benefit these people to stay on unemployment for as long as possible because they're going to continue to make more being unemployed than they are if they were working. Again, ladies and gentlemen, you can take the bait to these divide and conquer arguments, which are completely stupid at this juncture. Because, again, we are talking about $6 trillion. What part of this don't you understand? I know it's an outrageous number. I know it's huge. It's very difficult for us to comprehend such a number. Actually, I don't think it's possible for us to comprehend how much money this is and how long it's going to take for us to pay it back, because there is no free lunch. There just is no free lunch. And the fact that these senators continue to make these arguments tells me one of two things. They either have no type of economic advisor that is telling them that there's even a remote possibility of the things that I discuss here on this podcast, that we could be in the midst, the beginning innings of the greatest depression in the United States of America, which is going to be global too, but I'm just more concerned here within the United States, obviously. Or these senators are getting that type of advice, or at least understanding that that's a possibility, but they're just playing it cool and going after all of these stupid ideological arguments, which mean absolutely nothing, against $6 trillion. Because if they actually understood what's likely to transpire after this with the inflation and the hyperinflation and the fact that this everything bubble has been pricked by COVID-19, the coronavirus, right? Then they would know this means absolutely nothing. They would know that most of these people, unfortunately, are going to end up unemployed. That's what's going to happen. The Great Depression, unemployment peaked at about 25%. 25% peak unemployment during the Great Depression. That could most definitely happen this time around. I, for one, think it will. Again, I take no pleasure in saying this. I hope I'm wrong, but we've been arguing these points for a very long time as to what was likely to transpire in this economy, the global economy, given the policies that we have adopted and implemented. Fiscal policies, monetary policies, money printing. Again, nothing is free. The chickens are coming home to roost. This always happens. Yeah, maybe they can pull something out of their left pocket and kick the can a little bit further down the road, but all that's going to do is make the problem that much bigger because you've created that much more malinvestment and distortions within the economy. All of it needs to be cleansed. All of it needs to be wiped out. Well, we've seen, at least in respect to the S&P 500 and the Dow, that 3 years worth of gains, basically the entire Trump presidency, has been wiped out. So that pretty much tells you that the last 3 years have just been completely bubble on top of bubble, which we know. Even candidate Trump knew this, but then, of course, once he came to power, it was his bubble, so it was the best thing ever. Let's keep it going. And now we're seeing the fault in that. Got completely wiped out over the course of a few weeks. And now, over the past couple of days, we've seen a couple up days that closed in the green, and now people think it's the all clear. This is what happens in a bear market. You have these strong counter rallies. We talk about it all the time, and I will continue to because people will not understand this. People will not grasp this. There's a lot of people who haven't experienced these types of markets, and there's a lot of people who have, but maybe they forget or they don't study them. That's okay. That's what I'm here for. That's what this podcast is for. But you're going to see some of the strongest counter cycles, counter rallies within bear markets. This is a bull trap because people sitting on the sidelines are thinking, okay, the bottom's in, 35% drop. That's it. Time to get in. Discounts all over the place, value all over the place. Let's get back in there. Okay, up another day, up another day, up another day, and then boom, the rug gets pulled out from us once again. I imagine that will be the scenario because there's no ifs, ands, or buts that we are in a bear market. And these are the characteristics of bear markets. Could this time be different? I suppose there's always that possibility, but we have to play the probabilities, and I just don't think that's the case because of the mountains and mountains of debt that we have accumulated. And again, COVID-19 is not the cause. It simply revealed the cause. It revealed the problems, the underlying structural issues that have yet to be faced and are not being faced. There's no politicians up there saying, well, all these corporations overextended themselves, all of these share buybacks, we can't bail these people out. They squandered their resources. They had nothing but opportunity after opportunity after opportunity to save for a rainy day. You don't know what kind of rainy day it's going to be, if or when it happens. That's why you have a rainy day fund. Something to sustain you for a month, a few weeks, a couple months if you can, whatever the case may be. Let's just throw everything away. They didn't even put a lot of money into capital expenditures, investments for the future, to have something paying off. No, it was just all share buybacks. Let's enrich ourselves. Let's give a temporary boost to ourselves and to our shareholders until that's no longer the case, which we're in the midst of now. And all of those gains have been for naught unless people took profits and got out before this occurred. But how many suckers came in thinking everything was great because of the financial engineering all these corporations did, and they just lost a ton of money? I mean, if you lost 20, 30% in your 401k, maybe more, where's your bailout? Do you get a bailout for that? Do you get made whole for that? Because a lot of these corporations are going to be made whole. I mean, what's going on here? These are simple questions. These are simple points. Why are these not being discussed? Why are these not being argued? Well, it's unprecedented times. It's a pandemic. $2 trillion. Yeah, why not? And if that's not enough, then we'll do another $500 billion, another trillion, another $2 trillion. What difference does it make? Who cares? Federal Reserve will print it. What do they care? They got it. It's just zeros and commas on a screen. Makes no difference. There's no price to pay after the words. Just continue to do it. So the stimulus package, of course, is no stimulus, but it will pass. It was passed this evening, and it will be signed by the president in short order, of course. Pretty much praising himself or the stimulus package during his daily coronavirus briefing, talking about it being, the biggest stimulus package ever. I don't think, Mr. President, that's something you want to pat yourself on the back for. That's not a record you want to have, okay? It's just not. Tomorrow is going to be the widely awaited initial jobless claims number. It is expected to be in the millions. This is going to most likely be a record-setting initial jobless claims figure. How will the markets respond is anybody's guess. At the time of this podcast, again, after the stimulus package has been passed, the futures markets, we have the Dow down 0.5%, the S&P 500, and the NASDAQ 100 both down 2.75%. So, this is the futures market. Anything can change by the time they ring the bell in the morning. It's happened many times before, both ways. Futures can be down, markets rally during the day, and vice versa. You just never know, but I do like to keep this audience updated as to what's taking place at the time of this podcast. We have the Japanese markets down 3.1% after rallying strongly over the past couple of days. And the Australian market is also up 2.6%, continuing its bounce back. On the commodity front, we have crude oil, WTI, at $24.10 a barrel. Brent is at $27.20 a barrel. Natural gas is down slightly, 1.80 cents, $1.80 per million British thermal units. Gold is at $1,603 an ounce, and silver is at $14.33. So again, pay attention to the precious metal space. I do believe it is in the start or in the midst of a long-term bull market run, because they're just destroying our currency. They're just destroying the dollar. They're destroying every other currency under the sun, that being other central banks and their respective governments. So have some protection, be wise, have something that has held value and is not that volatile. So that's some of the market news. In respect to the coronavirus and the update from the president, he's still talking about potentially, quote-unquote, opening up the economy by Easter. Maybe not the whole economy, of course, but where it's okay to do so. And I hope that's the case. I hope we can. But the numbers, the data, it's just not indicating that that's going to be the best route. Of course, you continue to have Dr. Fauci up there saying it's flexible, and it's the virus that determines the timeline. You have some hospitals that are getting overwhelmed, and that's the real problem of this. It's not necessarily the mortality rate. Of course, it could be. It could turn into a lot of deaths, but it's really the overwhelming of the healthcare system. That's what it is. These are the doctors, nurses, technicians on the front lines. If these people get sick and they can't treat people, well, it's not going to be good for anybody. It's not going to be good for anybody. That's why you have this social distancing. That's why you have this self-imposed quarantines and all this, that, and the other. Because if these people get sick and they can't treat people, well, you see the problem here. That's what's going on, and that's what I've been stating here from day one. It's not a question of how many people die, although that could be bad, of course. It's a question of the healthcare system being overwhelmed, which is what we've seen in China. It's what we're seeing in Italy, and it's starting to happen in other countries as well, even here in the United States. Unfortunately, a first world country, and we're still behind the 8 ball on a lot of this stuff. So, I'm just saying this is far from over. And the underlying structural problems in the economy, our financial markets, we're just seeing the tip of the iceberg. This is it. Prepare yourself is all I'm trying to tell you. I had to take a look at the Federal Reserve's balance sheet because I haven't looked at it in a while. I wanted to see how much they expanded it in short order. And it is now at a record high, resting at $4.67 trillion. It's a record high. This is surpassing where it was not too long ago. not too long ago where we sort of made highs at 4.4, 4.5 trillion. Now we're basically at 4.7 trillion. Let's just round up because we know we're going to be there in short order. But if you actually look at this graph, and you can, very simply, if you went on Federal Reserve's website, Federal Reserve Economic Data, you can find this. And if you just type in assets under the search bar, it'll be the first thing that pops up for you. It'll read assets, parentheses, less eliminations from consolidation, Wednesday level, because the Federal Reserve updates this weekly every Wednesday. Okay? It's a mouthful. Why they can't just call this the Federal Reserve's balance sheet is beyond me, but I guess they want to sound intelligent or make it hard for people to find. Again, search assets, total assets. It'll pop up. You'll find it. $4.7 trillion. That's how you'll know you're looking at the right thing. But if you're currently looking at it, the graph is straight up. It's straight up. That's what it is. Straight up, because they are printing money, buying treasuries, buying mortgage-backed securities. Now, with the passage of the stimulus bill and what they're now somewhat approved to do, they're going to be buying corporate debt straight from corporations, right? The primary market, one of their stupid facilities that they came up straight from them, and also on the secondary market. Commercial paper. Everything else they're going to get into. Commercial mortgage-backed securities. Because commercial real estate is going to take a beating. Make no mistake about it. This is the everything bubble, so everything under the sun is going to be bailed out to some degree. Will it make its way back into the stock market? Perhaps, because they're going to be buying ETFs too. That's going to take place in short order. And nobody cares. President doesn't care. Kudlow doesn't care. Mnuchin doesn't care. Republican after Republican after Republican doesn't care. The Democrats don't know any better. I mean, what's going on here? It's ridiculous. Straight up. The last time you've seen anything like this was during the depths of the great financial crisis, when our genius central bankers at the time, and of course many of them are still there in some form or another, came up with the idea of quantitative easing. And just for a little bit of historical context, Federal Reserve was enacted in 1913, opened its doors in 1914. So if you take the history of the Federal Reserve from 1914 up until the great financial crisis, you had a Federal Reserve balance sheet of about $800 to $900 billion. Okay? That whole time, it took them that long to get to $800, $900 billion, which of course is still a big number, but it took a long time to get there. Then in the course of the great financial crisis, almost overnight, over a period of a few short months, you go from that $800, $900 billion figure up to 2.1, 2.2 trillion. You more than double it in the course of a few months. It calms markets down. Well, what are these guys doing? Maybe they actually know what they're doing. We can sort of start to calm down now, because these geniuses at the Federal Reserve figured it out. They can print money and they can fill the hole up that they caused, and everything's going to be okay. Of course, we're realizing now, 10 years plus later, that that's not true, which we knew at the time. We wrote about it because I'm going to read some of my book tonight, The Cynic's Guide to Investing, just a couple paragraphs. But that's what the Federal Reserve did. Then it plateaued a little bit, and then the stock market sold off because it started to lose its juice, its magic. And now you have the whole financialization of the entire country because of quantitative easing and the like. Markets threw their hissy fit. Central banks said, oh, market threw a hissy fit, they must want more quantitative easing. So that's quantitative easing number 2. Continue on for a little bit longer. Another hissy fit. Operation Twist. Another hissy fit. Quantitative easing number 3. Then they said, all right, that's it. We're at $4.4, $4.5 trillion. We're going to level off here. Then the economy finally at least appears to look like it's coming back. Finally, after a decade of nonsense, it finally looks like it's starting to come back. So let's start to normalize our balance sheet and go from quantitative easing to quantitative tightening. Jay Powell's now the chairman of the Federal Reserve. It's on autopilot. The economy has legs underneath it. We can now start to normalize our balance sheet, which one would presume would mean maybe back to $1 trillion, maybe even two. Okay? We couldn't even get down to 3.7. That's all it took. We go from 4.4 trillion down to 3.7. Stock market throws a hissy fit. Donald Trump throws a hissy fit in the fourth quarter of 2018. All reversal. Stop on a dime. No more autopilot. No more quantitative tightening. No more interest rate hikes. That's it. We're going to wait and see what happens. Oh, well, now we're seeing what happens, aren't we? Interest rate cut, interest rate cut, interest rate cut. Back to quantitative easing, emergency meetings. We are now back at the zero bound, ZIRP, zero interest rate policy. Today, I'm sure many of you are thrilled. You probably threw a celebration, had a piece of cake or something, because there were negative rates on the short end of the curve. Treasury bills entered into negative territory. Ain't you proud to be an American? It's ridiculous. But now, once again, in the midst of quantitative easing infinity, we have no idea when they're going to stop this. They're not. We have another graph that is just straight up. So we'll be at 5 trillion before you know it. Maybe if I remember, I'll try to make this a weekly thing when they update this on a Wednesday or Thursday. I'll try to do this just to see where they are. Because we got to pay for this. This is going to be paid for. This is your inflation. This is your hyperinflation coming to a theater near you. And then all of the problems associated with it. Doesn't mean it's going to happen overnight. It's a big economy. There's a lot of people, a lot of moving parts. But it will be here. It will come. It will rear its ugly little head sooner rather than later, I do believe. And with it, all of the problems associated. So that's it. You can check that out again. Federal Reserve economic data. Type in assets. You'll find the Federal Reserve's balance sheet. A couple paragraphs from our book, The Cynics Guide to Investing. This is our final chapter or final conclusion in the book. I think I might have read this before on a previous podcast many, many months ago. But now it just seems like it's so timely that we have to bring this up once again. And recall, this book was published in 2015. While one of the key points that we make pertains to having and keeping a long-term investment strategy, we caution that the short and mid-term environment can prove highly volatile. Well, that's where we are now. We believe this to be a function of the status quo, especially with regards to fiscal and monetary policy. The data that we have provided herein should make it crystal clear that major government programs are unsustainable. Further, and perhaps even more importantly, we are in the midst of one of the greatest experiments in all of economic history, which is probably going to take a back seat to what we're about to do, which is going to be an even bigger economic experiment. The amount of fiat currency that is in circulation around the world is nothing short of astonishing. What we do know is that if history is any guide, the debasement of a nation's currency, coupled with ever-increasing public expenditures, does not end well. Having the necessary information and education on these matters is paramount if one seeks to protect himself financially. We believe that this book has met that threshold and has provided additional sources and ideas about where to conduct further research. We are undoubtedly cynical about the system and would love it and would love nothing more than to experience and be a part of the proactive transformation to restore the United States to free market capitalism. However, we unfortunately find this to be an unlikely outcome until the current system fails and collapses beneath its own weight. Yet should the system fail, and we believe that it will, what is likely to transpire? In the short term, we would anticipate a, quote, flight to safety, which would ironically consist of demand for U.S. dollars, U.S. government debt, U.S. markets with emphasis on large-cap corporations' stocks and bonds, commodities, and precious metals. What will transpire in the mid to long term will depend largely on how people and societies around the world respond and what economic and political systems they adopt. Well, now we are in that midterm. This is the point. This is the fork in the road. What decisions do we make? Well, tonight we made the wrong one. We passed a monstrosity of $2 trillion and gave the Federal Reserve the A-OK to print $4 trillion. And that's not going to be enough from both sides. It's not going to be enough from the Fed, and it's not going to be enough from the government, which of course is us. We're the taxpayer. They don't make money. They take it from us. So we've seen that. And some of this, of course, is going to play out differently. The dollar shortage liquidity problem that we're seeing, right? So a flight to U.S. dollars, we're still in the midst of that. U.S. government debt, because it still has, at least on longer end of the curve, a positive nominal rate. That's where a lot of people flock to. Now we're starting to see that unravel a little bit. U.S. markets, that's what we witnessed in this melt-up. Right? You've heard these acronyms, TINA, T-I-N-A. There is no alternative. So where are you going to put it? You're going to put it in stocks. Why not the U.S.? Best looking girl at the dance, right? Until it isn't. With an emphasis on the large caps. Those big boys, your Apples, your Microsofts, your Googles, your Amazons, Facebooks, Netflix, all those names, right? The big boys. Commodities, we haven't seen that yet. We've seen deflation hit the commodity space on most of it. However, if inflation, hyperinflation does come around, well, then you know what's going to happen in the commodity space. And precious metals, of course, we've seen a little bit of a rally, but I think we have not seen the best of it. The best is yet to come when it comes to precious metals, in my opinion. And then lastly, we believe that there are three problems that exist within the current system. These are big government, our current monetary policy, and a lack of knowledge by the people regarding what negative effects will transpire due to big government and monetary policy actions, exactly where we are today. Therefore, the solution is education. While there is plenty more to be discussed, the Cynic's Guide to Investing at least provides you with the necessary tools to construct a long-term, successful portfolio. This is imperative as you seek to take control of your financial future so that you may reach your goals and provide for your families. This book, again, was published in 2015. It reads like it was published yesterday, with the final warning in our book, because the bulk of the book was bullish. It was long stocks, long equities, because we understood the paradigm, we understood the era, we understood the game that existed. And you can either sit on the sidelines and wait it out, or you can get involved and play the game and win. That was the purpose of the book, as coupled with education and data and all that other good stuff. But at the end, we issued that warning that this is going to come to an end, that this is not going to end well, and that you better be prepared. And we haven't written a second book, at least not yet, but that's why I started the podcast. To tell people, look, yeah, we wrote the book, but now that game is coming to an end. And it is. And we're in the midst of it. I don't take any pleasure in being right about this because it's going to negatively affect millions, if not billions of people globally. How did I know that this was likely going to happen? I'm nobody special here. I mean, it's understanding basic economics. This is not any type of complex theory going on here. This is supply and demand. This is understanding what debt and credit really is. And extrapolating it and expanding it and just asking yourself some basic questions. Well, if this happens, then what happens as a result of that? And then if that happens, what happens as a result of that? And you just continue with these thought experiments. That's what economics really is. It's not all of these fancy mathematical models. Because if that's what it was, then most of these people should have predicted this. And they did. And they didn't. Excuse me. And they didn't. So what's all the math for? Just a bunch of nonsense. It's a bunch of nonsense because you're not going to predict what people are going to do and when. with that type of accuracy. So your models are pretty much all for naught. It's people who are math-based, who want to put something together. I like doing them myself, but I don't put a lot of weight in them. I don't. I put more weight in my common sense thinking, the logical thinking of it, the thought experiments. If this happens, what's likely to happen as a result? And then you can assign some probabilities to those things. And there's no crystal ball. Nobody's going to predict these things to the date. But you can get close. You can understand what's going on. And that's all I try to do here, do my best, and to position myself accordingly. With what I do, with my personal investments, whether that's getting into cash, whether that's making sure you're in defensive plays, whether that's getting into bonds, whether that's getting into something like a utility, whatever the case may be, precious metals, hedging yourself, because something just doesn't seem right. That's what I say on this podcast all the time. It's what we warned about in the book. And here we are. And if I'm right about what comes next, well, then strap yourselves in, because it's going to be a roller coaster. Because I don't think inflation is going to do it. I think it's going to have to be hyperinflation, because if you understand what else we talk about in the book with those unsustainable government programs, especially Social Security, Medicare, and Medicaid, and then you continue to look at how much money we're spending on defense and on the war effort that's not ending. And then, God forbid, but again, if history is any guide, we will end up in some type of hot war once again. So all of this money is going to have to be thrown to a war effort, to Social Security, to Medicare and Medicaid, which is already virtually insolvent. When you look at it from an unfunded liability standpoint, meaning projections well into the future, the promises that have been made but are not going to be kept is in the hundreds of trillions of dollars. So you think this $2 trillion is going to rescue anything. You're just not paying attention. Thank you so much for joining me today, ladies and gentlemen. Please like, share, subscribe, get the word out, and leave your comments. We do love hearing from you. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.